and I shall begin with the well for the session. So any queries, feel free to post in the chat box. I'll be more than happy to answer your queries, and feel free to ask any kind of queries, any kind of finance related or market related queries that you have, right? I won't be advising, suggesting or commenting on any types of stocks, right? My job role doesn't allow me to do so, right? As you all know, I'm currently working for JP Morgan Chase and Company in the asset management division, and I can't recommend or talk about stocks, right? But I can talk about markets in general. I can help you figure out what's happening in the global markets or what is related to a particular financial concept or valuations, modeling, right? The capital structure, because I've received multiple questions on valuations, also on financial modeling also. So not to worry about the same. It might happen that you might not understand those concepts. It might be too advanced for a new beginner like who has joined this session. So not to worry about that. Feel free to ping me after the session. I'll be more than happy to discuss those in depth, or I'll be happy to share those content with you, like so that you guys can have that knowledge. Or it might also happen that for the guys who are already into this field, they might already have such advanced knowledge and might find these concepts as very easy. So not to worry about that. Just keep it as a revision session for you. Okay, so both set of people can be there. So the first question that I got from a LinkedIn community was, they asked me that how do we pick up an undervalued stock, right? Or an undervalued company or a security. Now here, I would be telling you in general, like some of the parameters also which I use, which you can implement as well. But if you guys have some better metrics, feel free to ping me, right? I'll be more than happy to take your metrics as well and give you my commentary. Okay. So whenever we are trying to pick up a stock, right, or a particular company's share or a security, a few parameters that we're taking into consideration, and also a very popular question asked in your investment banking interview. When you tend to go for your equity research profiles, financial modeling, valuation, investment specialist profiles, this thing is very popularly asked to you. The parameters that you take into consideration to find an undervalued stock. Now, the answer will also help the people who are trying or seeking jobs into this field, or they're trying to upskill themselves and want to land into such profiles and preparing themselves for mocks. So a few of the questions might help them as well. So the few parameters which I take into consideration is, and the parameters can be contradictory as well, and that I'll explain how. So first parameter is talking about the price to earning ratio or the price to book value ratio, right? So generally we are trying to use price to earning ratio and price to book value ratio for a majority of the companies, right? So price to earning ratio and price to book value ratio can be used for different types of companies. Like for example, if you're going for an asset intensive company, right? If you're going for a heavy industrial company, an asset intensive company, price to earning might not be good. In that case, we are taking into consideration a price to book value, because we are encapsulating the book value of those assets, those fixed assets which the company has into consideration, and we are assigning a particular price to that company on the basis of the assets the company has. And similarly, the thing goes for the banking sector. Like if we talk about the BFSI space, right? Generally, we are using a price to book value ratio for those sector, that is the BFSI space, the banking, financial services, insurance space. Some people tend to argue using a price to earning ratio, but price to book value is a better metric. I'll tell you why. Because I am having a separate question upon banks. Okay. So what I am taking into consideration, a company having a lower price to earning ratio or a price to book value ratio. Now, again, that can be questioned. I'll tell you why. Because the thing is, even if we tend to choose, because the theory tells us, the financial theory tells us that buy an undervalued stock, having a cheap price to earning ratio, a lower price to earning ratio, or a lower price to book value ratio, right? Buy a stock having a lower price to earning multiples or price to book value multiples, and sell off a stock having a higher price to earning multiples or price to book value multiples. Agreed. That is the thing that will also work practically. But the thing is, if a stock is trading at a lower price to earning multiple or a lower price to book value multiple, it is not compulsory to purchase that stock. A stock might be trading at a lower price to earning multiple or a lower price to book value multiple, also because of the market sentiments, because the stock is really very bad. The stock has no profits, like no revenue forecast, no cash flows. Company बिल्कुल बकवास खराब company चल रही है. It might be a penny stock. The debt might be too high in the capital structure. The management outlook might not be so good. The company might be into bankruptcy, right? And ultimately, the ratio might be trading too low. Again, here the theory fails. It's not good to buy a cheap price to earning company. It's always good to buy a lower price to earning company or a price to book value company when all the positive parameters are supporting the company. The revenues are good, the cash flows are high, the margins are high. Even if the debt is high, though I prefer a company having a lower debt, but if the company has a higher debt, that debt must be justified. The company should have plans laid down to reduce that debt. The management of the company must have some positive commentary about the company or the stock, about outlook, about future expansion plans. All these positive commentaries must be there, right? And one parameter which I take into consideration with these ratios is if a company has more debt, the cost of debt should be less than your cost of equity, correct? Because till the point of time, your cost of debt is less than cost of equity, right? Taking more and more debt will always have a magnifying effect upon the EPS of the firm, right? I repeat this point, a very important point to be noted down. Till the point of time, the cost of debt is less than cost of equity. Taking more and more debt will have a magnifying effect upon the earnings per share of the firm, right? That can be proved manually through calculations, though we can keep some separate sessions upon like diving deep into that. And all these things are also taught in my training curriculums as well, right? So that thing can be taken into consideration ideally, right? But I'm keeping this session very sweet and simple for 30-35 minutes, answering all your questions. And the people who have not asked the questions can post their questions in the chat box. Okay. So that is one thing. Even selling a higher price to earning company, a company having a higher price to earning multiple and selling it off might also not be good always. Because till the time the earning growth is justified, a higher price to earning multiple company can also be bought or kept at a neutral stage, or you can even plan to buy more if all those projections, like regarding revenues, cash flows, margins, debt, your management commentary, expansion, the company is really doing good in all the parameters, stands very great. So that earning component, and that is your EPS, because when we talk about price to earning ratio, we are taking into consideration what the price in the numerator and dividing it by the EPS in your denominator. So EPS is the earnings growth, right? The growth of the company is judged by the growth rate in the EPS. And ultimately, that price to earning ratio will also be determined by the earnings growth in EPS or the growth rate of the EPS per se. The EPS is rising, right? And again, the price is also rising. That's completely fine for the company, right? Because one thing is also that you need to understand is price is a leading indicator, right? And EPS is a lagging indicator. Why? Because EPS, you only get to know because the formula for EPS is you have the profit after tax and dividing it by the outstanding shares. You always get the profit after tax on a quarterly basis or annual basis. You don't get the profit after tax of the company on each and every day. When the company publishes their quarterly reports or annual reports, at that point of time, you get to know the profit after tax for the company, right? Whereas the price is driven by sentiment as well. The price of the company might change because we tend to see the price fluctuating on every day. Sometimes the stock falls down by 5%, 10%, 15%. Like sometimes the company crashes completely and there's a lower circuit. Sometimes the stock prices rises suddenly by 10%, 15%, 20%. And at that point of time, there might be an upper circuit. Correct. So price is also driven by positive news and sentiments. There might be a positive sentiment in the market, or the management has stated something very good about the company. The company is going for some expansion, diversification. The company has got some government support, and like all these things might be there. So that might drive the price above, but not the earnings, because earnings are lagging. Once they get, that number will change at that particular point of time only. But since price is a leading, it will change on everyday basis. Sometimes there are false or like misleading news about the company. Even if the fundamentals are strong, the earnings are strong, that the price comes down because it has been some kind of a misleading information. Sometimes the misleading information is on a positive note. The price rises in a skyrocket manner, but the earnings are stagnant, right? That is why we tend to consider price as the leading indicator, because it is also driven by sentiments, and EPS as a lagging indicator. But ultimately, we need to see quarter by quarter or month by month if we can get such growth rate data, that how a company is growing. So price to earning ratio or a price to book value ratio, I won't be saying having a lower or high, but a good ratio which is justifying everything. Second parameter which I take into consideration is the company should be a high growth company, because ultimately the company which is a high growth company might have a higher price to earning ratio. The growth should be justified. Right here, I'm not talking about startups or loss-making companies, because those companies are also the high growth companies, because those are in the initial stage. That can be kept as a separate topic sometime later. But here I'm talking about the profitable companies. So again, the growth rate of the company should be high. But if the growth rate of the company should be is high, the company might have higher amount of risk as well. And that is the risk that we are taking to buy particular stocks and not a particular mutual fund, right? And that is the reason we are going for a stock and not a mutual fund, because we want to take that risk in the market. Okay, I'll be just changing my network. I feel there is some issue. Just let me know if I'm clearly visible and audible. Heads up in the chat box if I'm audible to all and visible to all. Am I audible to all and visible to all? Perfect. So that is the thing that you need to take into consideration. So wherever you feel my network is getting stuck, right, just let me know. I'll change my network. Okay. So that is the thing. That is a higher risk that you are also taking with that growth, right, to get that return ultimately. Because now here the people might question that that a company which is mature might not have a higher growth rate, right? And that company might be trading at a lower price to earning multiple or price to book value multiple. These are one of the parameters. These are not the only parameters. Correct? Correct. So that thing also we need to take into consideration. Now the growth rate and margins need to be taken into consideration. Because nowadays we have even seen the mature companies' margins and revenues grow at a very high rate. There were multiple companies like HUL or Alliance, like which were stagnant for many past years, right? But their earning growth were really high, right? But people were not pricing that into the price of that particular company. So growth and risk is one of the parameters, right? Not the only parameters. So when you are taking into consideration the price to earning or price to book value, always have one thing in mind. You have to take into consideration the growth of the company and the risk of the company. It can be high, it can be low. The risk can be high, can be low. The growth can be high, can be low. No fixed parameters, but the fundamentals should justify. It's always a story of fundamentals, right? And the company should have a higher return on equity, right? That should be shown in the financial statements. Now, here the question might also come. A company might also have a higher return on equity when the base is very low. That is, your formula for the ROE is how much? It's your profit after tax, and you are dividing it by the outstanding shares of the company, the base of the company, right? Or like if you're talking about the ROCE, it's your EBIT into 1 minus tax divided by your capital employed, the debt structure plus the equity structure, right? So ultimately, if the company is raising that money from equity holders, from debt holders, the company might be using that for some expansion opportunities, for some diversification opportunities, right? And the ROE of the company might be high if that base is very low, right? It might happen that the company is not raising equity and debt for some production and expansion purposes. That quantum is very low, and as a result, the ROE has become very high. So this thing we need to take into consideration. If those debt and equity are not being used for expansion diversification purposes, or the company is raising less equity and debt for those purposes, in that case, the ROE might be artificially inflated, right? So this thing also we need to take into consideration. If all these expansion diversification activities are being done and still this ROE is getting higher, right? Because there's always a gestation period. The company won't be delivering an ROE currently, right? If those expansion diversification projects have been made into consideration. But the company which has been running from past 10, 15, 20 years might already have covered the gestation period for those 5, 10 years project, right? Like far behind the line. So uska to ROE the company must get, correct? So all these things we need to take into consideration. So ideally, what do I see? And it can also happen that a high growth company might also pay you a higher dividend. Right? So might not always, but can be a possibility. So ideally, for to pick up a company, looking at your price to earning, price to value multiples, so fundamentals of the company, the growth rates of the company, the risk parameters of the company, the ROE of the company, right? So all these things need to be taken into consideration. And when I talk about fundamentals, I talk about margins, I talk about profitability, I talk about cash flows, the capital structure of the company, the management commentary, and all those numbers which are getting published or talked about by the management of as a result of the future forecast. So that is one thing which I take into consideration always. So that was one question that was asked to me, right? Just keep listing down your questions, like any questions if you have. I'll be more than happy to take them in the chat box. Correct. One important question that was asked to me was about the US recession, right? Will we really have a recession in US? So that one thing was asked to me, right? Or will we have a soft landing? right? Because currently we are believing to have a soft landing, not because of everyone is talking about soft landing, because the indicators for soft landing are there. Because ideally we talk about three types of scenarios if we talk about the US economy, or we talk about any kind of economy per se, right? But currently these are getting highlighted more for the US economy, because the US economy, again, having the reserve currency USD, globally it drives the country of US globally, directly or indirectly drives the whole, drives all the countries globally, right? And if there is a recession in US, so there's always a contagion effect, right, in the other countries also, which we have seen in the past years as well, like whenever the US faced a recession. So currently what is happening, all those numbers, though the numbers of GDP, and there have been numbers about the wage growth, there have been numbers about the unemployment rate, those numbers are pretty decent, though completely agreed. Now people might be talking about the GDP was expected to grow by a higher percentage in the previous quarter, but the GDP numbers came down in US. Even the wage growth has started to come down. Even the unemployment rate has started to increase by a bit. But the quantum of increase that they were expecting for a recession is not there, right? So those parameters aren't there. They're pretty decent numbers, not very bad numbers. Inflation is still a problem in US. Though we saw the CPI for April month, if I'm not wrong, it increased by 0.3% or something, by 0.2% or something, right? It came around 3.8, 3.9%. But ideally in US, they tend to look towards the personal consumption, right? Your PCE numbers, the private consumption expenditure numbers, which takes into consideration all your personal expenditures, insurance numbers, all that stuff. Because the shelter inflation and insurance inflation has been a concern in US, right? So that number was marginally down. On the basis of CPI numbers, the people were expecting that the Fed will increase the rate of interest now because the rate of inflation has risen. But they mostly track the PCE number. So that were down by 0.3%. Correct? So the Fed has delayed the reduction in the interest rate. People expect that the rate of interest might come down in September or maybe December, right? The first cut might be there in September, and the second cut might be there in December, or the first cut might be straightforward in December 2024. So those things are there, but the time will come, be it like the late 2024, be it in December, or be it the early 2025. The Fed has to reduce the interest rates. Why? Because the unemployment number is rising, the wage growth is falling. And in US, they popularly track a metric, which is your job openings divided by the unemployment rate. So that ratio is falling. Why? Because the unemployment rate in the denominator of this ratio is rising, and the job openings are either falling or constant. So that is very bad. Ideally, the job openings should rise, and the denominator, the unemployment, should fall. Correct? That's a question of skill set also, but that is the thing that's happening in US. Okay. So that is the thing which is happening as well, and that we need to take into consideration. And ideally, what happens in a case of soft landing or recession, the yield curve is a very good metric to predict that. If the short-term yields are higher than long-term yields, it might predict that the economy is going towards contraction, a kind of a recession. Not a recession might be a harsh word, but a soft landing. The economy might be growing at a slower growth rate. It might not always indicate a kind of a recession, sorry, but a slower growth rate. Correct? And when the long-term interests are higher than short-term interest, it's a scope for expansion, right? The growth of the economy. And even a flattish curve, it is still safe, because if I just share my screen with you, a very popular way and very easy way, right? Which I also see. I'll just share my screen with you. These rates, right? You can easily find it on social media platforms. You need not remember these rates. Correct. So see, I just went to Google. I'm just sharing my screen with you, right? So I just typed on Google US 10-year bond yield, right? Very simple measure. Like if a layman is there, like, and he wants to know the yield, short-term yields and long-term yields, how to know that, right? I just simply typed US 10-year yield. So US 10-year yield is currently, and with the short-term yield and long-term yield, we can predict what? We can predict a soft landing or recession, right? And in that case, the short-term yield should be higher than long-term yield. Okay. 10-year yield हमको मिल रही है 4.43%. So just remember this number, 4.43%. Let's check the 5-year yield. 4.43 था 10%. 4.46. 4.43, 4.46. Correct? बहुत ज्यादा difference नहीं है, but still your short-term yield is higher. Correct? If I just go back and see the 2-year yield, right? Because 2-year yield is something that will, because the near-term yield, it shall price all those inflation concerns also, right? Because the long-term yield might be lower because till that point of time, the yield assumes that the rate of inflation has come down, but the near-term yield might be higher. 4.8. Yeah, clear-cut difference, right? So the short-term yield of 2 years is being higher than the long-term yield of 5 years or 10 years. Difference is not so much, but the difference is there, right? The yield curve is completely negative, right? By minus 0.4% or something, right? So that is a soft landing scenario. Earlier, this gap was very wide. This gap was very wide and the yield curve was completely inverted. So it's still inverted, but not by that magnitude. Interesting study. Let's take for India. Okay. Because India is in a growth stage, they say the yield curve is flattish. There is no fear of recession. 2-year bond yield, if you see, exactly 7%. You just had that pop up. I just close it. 7%, like 7.003%. If I just go back and check 5-year yield, 7.023%. 7.0%, 7.023, all the same. Okay. And if I just take about 10%. So we can see it's almost flattish here, right? 7.018, almost flattish. Okay, much better state than US, right? So that things can be taken into consideration, and you guys can just see these numbers directly from online website and try to see and compare those inflation rates, those interest rates, right? So that is one thing that you need to take into consideration. So I'm having one question in the chat box. Will a global recession cause the gold price to reach 1 lakh per 10 grams and the stock market to decline? Or is there any possibility that India could also face a recession phase? Completely bang on question, as we were just discussing the yield curve scenarios, right? And we were discussing about this scenario, like while comparing US and India. So I believe the second part of the question is already answered, Aryan, right? As we just try to compare the yield curve numbers. And also, like if we talk about the GDP growth rate in India, like it's beating the expectations. The corporate profitability has started to rise, right? The inflation numbers in India is steadily falling. The RBI might reduce the interest rates very soon. And all those different indicators regarding your inventory to sales ratios, right? So like if we talk about your debt to GDP ratios, if we talk about the capacity utilizations, all these metrics are very positive for India, right? So India, the possibility of recession is 0% in India, but the possibility of a recession in US is there, but very less, be like 15 to 20%. Soft landing is very high, right? So that is one thing. And answering the first part of your question, will a global recession cause, the global recession might cause the stock markets to decline, right? Might cause, but not actually, because we cannot predict the stock market, to be very frank, right? The stock market might correct if there is a global recession, but that might not be the case, right? Because the US is going towards a soft landing, because the numbers are telling, all the numbers, there's not a single number in US that portrays a recession. Everything portrays a soft landing, right? There's not a single number in India that portrays a recession, right? It all portrays a Goldilocks scenario in India, right? And all the countries, if I talk about, there is nothing, a thing of recession. Like there might be some backward countries, like where they might be, the country might not be doing really well. So those countries don't impact it, right? Basically, the US and European economies might impact the global economies, right? But currently, we have seen even the US stock market is also doing good, right? Your S&P 500 index has risen by 10% YTD, right? It was down in April. It was the only month since October 2023 that S&P was down by 4% in April month. YTD, if you talk about, it's a 10% positive return, right? You can talk about companies being overvalued, but the thing is the market overall is doing well, right? And if there is a global recession, hypothetically, the markets will get impacted. But nowadays we have seen economies like India, they have been quite isolated with what's happening in the other global economies. They're running in their own way. But here the question can also arise that decoupling, right? That the US market going some other direction, and Indian market might going some other some other way. Till what point of time it can happen? So no one knows that answer. But having the growth story of India, we can completely say that the fear of recession might not be there, will not be there. And hypothetically, if there is a recession, every economy gets impacted. But some good working economies, their market might not crash. The country from which the recession starts, the stock markets might crash there. But the countries where the recession do not start or which are just having a contagion effect and the growth rate of the countries is doing good, the countries internally are doing good, that markets, a stock market might not crash, but only face a correction. But again, the gold prices might reach. If there is a global recession, the gold prices might reach because people go towards two things. They either purchase the USD or they purchase gold, right? In terms of these calamities. And nowadays, they're trying to move away from gold because USD being the reserve currency and the US economy has been blamed to transfer inflation to other countries because it prints endless amount of money, right, to meet its debt obligation. And it also has freezed, right, the reserves, the forex reserves of Russia, like somewhat China maybe, or like some other economies which are doing some kind of invasion into some other countries. And as a result, these countries have gone towards gold and purchasing gold because you can't block the gold reserves of the country. The gold can be used as a medium of exchange, right? So that is one thing. So the demand for gold in that situation will ultimately rise. And be it a recession or not a recession, the price of gold will rise ultimately. It can even touch to 1 lakh as well. There's a prediction by multiple banks to 1 lakh because be it a recession or not a recession, the price will rise because all the central banks have started to accumulate gold now because they want to move away from USD being the reserve currency. I hope, Aryan, it answers your question. And all these things are being taught in depth to all the people who are here, like into my live training sessions. In depth, these things are taught, right? So all these things are being taught. And if you guys are interested, you can also join me like through my training session, like where I charge a very nominal fee. It's not even a very high fee. Okay. So in-depth discussions about all the economies, their macro indicators, all these things are done. So that is one thing, right? Any questions, just post in the chat box. I'll be not be taking more time in this session. Right? It's a very quick session, a very quick indication, like which I posted on my social media platforms. I didn't give my audience even like 24 hours to come back to the session, right? So I'll be just winding up that session, like this session in like another 5-6 minutes now, right? So that is something. One question which I was asked was like related to banks, right? And many analysts are using the price to earning ratio for banks and not the price to book value ratio. Though the price to book value ratio is also being used, but they try to give more weightage to price to earning. So the thing is, in terms of banks or BFSI space, price to book value is a better metric because the book value is taking into consideration the book value of the loans and adjusting the book value of the loans with the provisions. So that gives a greater indication because the bank works on giving loans and taking loans. And the margin that the banks earn is a spread, right? The net interest margin. So those people who are trying to say that the banks are overvalued, valued in terms of price to earning ratio, they might be wrong. Look at the price to book value ratio and not price to earnings. Because price to earning will give you the growth rate of the EPS in the denominator. वो ठीक है, वो grow हो रहा होगा. But price to book value is something on which the bank actually works, right? So that is one thing that we need to take into consideration. And also, there's a question about using free cash flow to firm or free cash flow to equity for banks. For banks, we always use free cash flow to equity. We create the financial modeling for the banks on the basis of free cash flow to equity, FCFE, and not the free cash flow to firm, FCFF. And like, what is the reason for that? Because if you talk about debt, right, debt is not a source of financing for banks, right? The other companies, like if you talk about some other kind of companies, right? Debt is not mandatory for them. They can do some expansion opportunities by having their cash flows, by raising equity. Debt is not compulsory for them. Now, here, I do not mean that banks do not have cash flows or earnings. They have enormous cash flows and earnings. It might happen that other companies might not have such amount of earnings and cash flows. But here I'm saying for the other companies, debt is not compulsory, right? If they're falling short of cash, equity, or they have some strategic objectives, they might take up debt. But banks have to compulsorily take debt because they're taking debt and giving debt, and that's a margin for the banks, right? The interest rate on the loans given minus the interest rate on the loan taken is the spread for bank, the net interest margin, right? So that is one thing. So debt is not the source of financing; it's a raw material for banks, right? And when we're talking about the free cash flow to equity, right? So that is the reason why we're taking into consideration FCFE, the free cash flow to equity providers, and not FCFF, right? Because FCFF is the capital that has to be distributed or cash available to all the capital providers, be it equity holders or debt holders. But FCFE is the cash which has to be provided to only to the equity holders, right? Because यहाँ पे तो debt holders ideally है ही नहीं, because debt is a source, is a raw material for banks and not a source. Because if the bank is not taking debt, the bank will not grow. Correct. And third thing is people have been asking about ROE and ROCE. Be it any company, if a company has debt, always use ROCE and not ROE, right? Because ROE is your PAT by the outstanding shares, right? It might happen that the debt of the company is too high and equity might be too low. So as a result, the denominator of this ratio, equity, might be too less and the ratio might become overinflated. It might give you a wrong indication. In that case, always look at ROCE. Okay. So that is one thing. Or also, we talk about your reinvestment activities, like while preparing a financial modeling, we calculate the reinvestment. Multiple methods are there to calculate the reinvestment. Feel free to ask me that, right? But for banks, what's the reinvestment, right? Like what the capex for banks, right? It's an investment in the regulatory capital. The capex for the other companies is towards expansion, diversification activities. But the capex for the banks is investing in the regulatory capital because they have to maintain an adequate capital adequacy ratio. They have to invest into that regulatory capital. Because nowadays we have like multiple regulations coming up by the RBI regarding gold loans, regarding AIFs, regarding personal loans, then credit cards, risk weight. So they have to invest into that capital adequacy ratio. That's a capex for the bank, right? So while preparing a financial model, the capex is nothing but the investment in the regulatory capital. So these few points always take into consideration. Okay. Any questions? Any questions, people? Also, like whenever you're calculating your risk-free rate, your growth rate, there are multiple methods to calculate the risk-free rate, the growth rate, the equity risk premium. You should know all the methods. It's not just like taking the difference between market return and the risk-free rate for equity premium, or taking the RF from a Google website, or just taking the growth rate of that sector. Multiple internal methods are there that you need to know. Okay. So that is one thing that you always need to know. Risk-free rate mein you are adjusting your default spread. You are subtracting the default spread of the company. Ideally, in equity risk premium, people are just taking the equity risk premium, subtracting the risk-free rate from market risk premium, and calculating risk-free rate from market return, and calculating your equity risk premium. Very basic, simple bakwas method, right? You have to be calculate the methods which people are using in the actual world. A very popular method is to tend to use the default spread of your particular country. Those default spread numbers are available on every social media platform, on Google as well, which are being displayed by different agencies. And the best way is how to calculate that default spread. Take the difference in yield of an emerging market bond minus the yield on a developed country bond. That will give you the default spread of your country, right? That is, if you want to get the default spread of India, take the yield on bond, the bond yield in India, and subtract it by the bond yield in US. And don't take it for 2 years and as for now. Take it at least for 10 years to have a more growth forecast to get that default spread. Once you have that default spread, you multiply it with the scalar number. And that scalar number is nothing but it's the standard deviation of the returns of an emerging bond index divided by the standard deviation of the returns of an emerging equity market index. So you get that default spread, you multiply it by a scalar number, which is again the ratio of the standard deviation of returns of an emerging bond index divided by the standard deviation of the returns of an emerging market index, India per se, and you add the S&P, the standards and poor index ka risk premium to it. Again, that number is available on all media platforms. A very popular method. Default spread into the scalar number plus the S&P, because we are taking into consideration the US premium because ultimately it is the US market at this point of time, right, which drives the global economy. So that is something which we have to take into consideration. But a kind of a better method, which I personally use, because I do not believe in taking that S&P premium. Why the S&P premium, right? I take a forward-looking approach because historical, because all those kinds of risk premiums that we're calculating are historical risk premiums, and these can be very noisy, very incorrect, and these can have a standard error of more than two. Then what's a standard error is a matter of separate discussion. It's a statistical tool, but we need to have a good metric, a forward-looking equity risk premium. In that case, I'd take the YTD bond method approach. And even the companies have started to use that. We calculate the YTM of the bond, having the market price of the bond, having those coupon payments, and dividing by the 1 plus R. Take the market price of the index. The coupon payments would be your dividends plus buybacks. All those amounts which an index is giving you in the form of the dividend and buybacks for multiple years. All this number is available on the NSE, BSE, and different platforms, and how much an index has given you in percentage terms or absolute terms for dividends and buybacks. Because interest payment is the coupon for bonds, but for the Nifty 50, it's your dividends and buybacks. For dividends and buybacks for the particular future years, you have that market index and dividing by the 1 plus R to the power of the years. There R you have to calculate. That YTM you have to calculate. And YTM is nothing but the risk-free rate. Subtract that from the market returns and you get a forward-looking equity risk premium. I know these things are easier to say than to do. Completely agreeing with your point. I understand there might be people who might be assuming कि क्या जल्दी में बोल गए मौर्य, right? But when you do such things practically, you get to know all that stuff. I am happy to teach you all this stuff practically as well, right? There have been people who have been a part of my training program, like very happy to learn all these methods. And similarly for growth rates, we have multiple methods, right? So that is one thing. These were a couple of things like which I wanted to discuss. Like we'll be giving some more intensive sessions, right, with more people around me. So keep on posting your queries or concerns to me. You guys are connected to me via LinkedIn. You have my personal contact numbers, most of you people as well, right? You guys can share off your questions to me through LinkedIn platforms, through like any kind of social media platforms. And you guys can also join my live training programs as well, which have really helped more than 10,000 people, right? So feel free to get back for concerns. Thank you so much, guys, and a happy evening. Thank you.